Check, check, 1, 2. Check it out, guys. Welcome to my channel. Today we're going to be going over some important things that we seem to have forgotten. Nobody wants to know about the boring stuff, which is the bonds and the reason why the markets could potentially go down from here. And everybody wants to believe that this is a new era led by tech, and that everything will be fine, and that we're just going to keep ripping up to the moon from here. And we're gonna try to be non-biased on this video. We're gonna try to go over what history tells us, what the markets are telling us by looking at the charts, and be able to figure out what it is that you should be thinking, what you should be doing with your money. What I do with mine is my choice, but you're gonna be figuring out whether or not you should be buying anything at all. So let's go over a few things. What I did here is I went back in time. So we're gonna go back in time. We're gonna get we are in the June. We are in June of 2006, and we extended it all the way down to September 2006. So this is what we're looking at. This is the SPY, and we're going to be going over a few things here. In 2006, the Fed paused its tightening cycle after raising the federal fund rates target 17 times between June 2004 and June 2006. The pause lasted for about 10 months, from August 2006 to May 2007. And so let's go over a few things here. In August 8th of 2006, which we're going to find right here, and let's make some marks. On August 8th, we're going to make this line. On August 8th, 2009, the rates were left untouched for the first time in 2 years, as the Fed came out and said its tightening of monetary policy was working. And so then you saw the markets go down a little bit. I have you on the hourly chart, on the daily chart, and you have here we went down 1, 2, 3 days. You had support right here. You had support. Let me get some marks in here. You had support here at, hold on a second. You had support here at the 200 moving average at the red line, and the market started going from there, right? So now we're going to switch real quick to the TLT to see what it is that the bonds did in 2006 at exactly that date. So we're going to remember that day. We're going to see August 8th, right? August 8th, and then we started going upwards, right? So let's go see what happened then. So here we are in TLT. We're going to again make our line, horizontal line, and we're going to look for August. Oops, that is not it. We're going to look for a vertical line, and we're going to look for the same day, right? More or less, this is where we are. Fed pauses, and TLT goes down 1, 2, 3, 4. It went down 4 days, and then something interesting happened here, because what happened is that it gapped up right here. It gapped up. It left a gap right there. And then it found support at the 200, then did another gap here. And then it took off. Came back down here. Came back down here. Again. Came down again. And it up again. Now, that's what happened at that exact date. Okay, now we're going to go over some other very important dates. So let's go back to the SPY now. So back again to the SPY now, and we are on August 8th, and exactly in August 8th of 2006, the Fed came out and said the Federal Open Market Committee decided today to keep its target for the federal fund rates at 5.25%. Economic growth has moderated from its quite strong pace earlier this year, partly reflecting a gradual cooling off the housing market and the lagged effects of increases in interest rates and energy prices. Readings on core inflation have been elevated in recent months, and the high level of resource utilization and of the prices of energy and other commodities have the potential to sustain inflation pressures. So here they are telling us that we're fine with inflation now. Things should be good from here. Although they said, however, inflation pressures seem likely to moderate over time. Doesn't it sound familiar? Inflation pressures seem likely to moderate over time, reflecting contained inflation expectations and the cumulative effects of monetary policy actions and other factors restraining aggregate demand. Okay. Nonetheless, the committee judges that some inflation risks remain. The extent and timing of any additional firming that might be needed to address these risks will depend on the evolution of the outlook for both inflation and economic growth, as implied by incoming information. Sounds very similar to the things that we're hearing lately. So then what happens? The market likes to pause, right? The market likes to pause initially. And what do? Then we start going up. Look at this. We go up, consolidate, up, down, wave up again, and we start moving upwards, right? That's great. Now we're going to move forward in time just a little bit now. So now I went forward a little bit, and now we are here in October of 2006 and expanded all the way to around January 2007. And at that time, as you can see, the markets start moving up, and we got a wave up, a wave down, wave up, wave down, wave up, wave down, wave up. What was the bonds doing during that time? Let's take a look. Bonds, as though you thought that because in October it found support, and during October bonds found support right here, right at this area, and this was during October. By the end of October, it remounted the 50 moving average. We had a wave up, a wave down, wave up, and a wave down. But you just saw that the markets were also going up, right? Markets were also going up. And look, by December, by this date, by December, bonds retrieve. What happened in December? What is it that happened in December? Well, let's take a look. During December, the markets were rallying, and this is the reason you're going to get a pullback, especially because people have been taking profits. So you had an area that you had basically a gap right here, another gap right here, and then it went all the way from, and let's get rid of all of these, and it went all the way down, all the way up to, from this line all the way up to that. So 56, right? So if you correlate that with the markets, then you're going to see that the market was reaching new highs during that time. So money comes off, risk off, money gets taken out of the less risky option, which is in that case bonds, and then you start putting it into the market as you see it coming back down. December, look, in December it pushed on back to the trend line, pushes back again, back to the trend line on the 50, comes back up again. Now we go move forward a little bit in time. Now let's start talking about the fun part, which is going to be, in fact, what's going to happen when the Fed actually cuts rates. Let's go over that. We now have gone forward in time. We have September of 2007 all the way up to March 2008. And in September 18th, let's look for that, September 18th. So it's going to be right here. September 18th, you had the Federal Reserve cuts the federal fund rates by 50 basis points. Here comes the first cut. First cut, happened there? This is the first cut right here. That's the first cut. So September 18th, right? September 18th, right at that line, you have the first cut, and the Fed cuts by 50 basis points uh, to 4.75%. This was done in response to increasing concerns about the impact of the subprime mortgage crisis on the broader economy. And so the SPY, what does it do? Goes up on the first cut. How long did it go up for? Let's look. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18. It went up for 18 days. 18 days up to that bar right there. 18 days. And so $18 days it went up. Now I want to analyze exactly the same date. I'm not going to change the date. I'm just going to keep the same. And I'm going to now go back to TLT. And I want to see what happened in that same exact date. Right? We said September 18th. And we're going to go over here and we're going to find September 18th. Here it is, September 18th, at that blue line that you're seeing here, vertical blue line. September 18th, first rate cut. We go down for 1 day, 2 days. We found support right here at the 50 moving average. And we start moving up. The first push is going to go from $55 all the way up to, no, $55 all the way to 57. Comes back down to the line, starts moving. Consolidates, this time moves higher, right? What does it do next? December, consolidates, comes back down, hits the 50 moving average, and does another one. Comes back down. Another support right here at close to the 50 moving average, but this time was able to come down and break below it, and it does a doji. It does another inverted hammer. It gives you another hammer here, and then it goes and it gaps up and it gets above the 50, and it pushes on up one more time this way, right? So going back to now we're going back to of why was this happening, right? Let's clean this up a little bit, and then we're gonna see what happened next. So let's mark now the another vertical line, and this is gonna be in October 31st, 2007. October 31st, which is gonna be right here. October 31st, right there. October 31st. What happened on October 31st, 2007? The Federal Reserve cuts the federal fund rates by another 25 basis points, cutting it down to 4.5%. Now I ask you, TLT went up when the Fed cut rates, right? Look, it went up here when it first cut rates. Then the Fed goes again and it cuts rates one more time. What happened in October 31st in the markets? Let's look. This time I went back to the SPY. You guys can see here. I went back to the SPY. And back to the SPY right there. We're back at it. And this time I marked with this vertical lines, I marked for you every rate cut that happened. Are we going to go over and see what happened, right? What we should be expecting. Look. I marked here October 31st. We talked about 25 rate cut. So that happened here. Cut rate right there on that vertical line. I drew that blue line, vertical line. That is a rate cut. What happened there? Markets pull back, right? Markets pull back. Then what happens again? We try to recover, get back above the 200 moving average, above the 50 moving average again. And then the Fed cuts again, cuts again. In December 11 of 2007, the Federal Reserve cuts another 25 basis points down to 4.25. This will be the third consecutive rate cut in response to ongoing turmoil in the financial markets and weakening economic conditions and all of that. What does this tell you? That the Fed only cuts when something is broken. So you, as a bull, do you want the Fed to start cutting? Do you really? Because when he starts cutting, that means something is breaking or about to break. Now, we go to the next line. Next line would be, this is going to be January. So January right here. January is going to be right there. January 11th, 2007, the Federal Reserve cuts another 25. We talked about that one. And then January 22nd, look at this right there. That blue line that I marked, vertical line. Okay. Now, what happened there? This line right here. That line right there. January 22nd, the Federal Reserve cuts 75 basis points. Now, this aggressive rate cut was made in an emergency meeting, and it was intended to support the economy due to deepening housing crisis and a deteriorating economic outlook. What does that tell you? He was going 25s, 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 and all of a sudden, you know what? Shit, cut 75 because these things are not getting. This is not good. We increased too much rates. Now we've got to start cutting. You want to cut. You don't want to cut them all at once, but then he starts going. Now, with those dates in mind, let's go switch over to bonds and see what bonds did every time the Fed cut rates. So here we are back in TLT. You can see here, TLT right there. And so we're back, right? So let's go over again. So we have September. We have the first rate cut. It's supposed to be positive for the markets, right? But instead, it was positive for the bonds. Bonds go up. The Fed cuts another 25 right here. Another 25. Bonds go up again. And as markets are pulling back. I just showed you. Markets pull back when the Fed cuts. Then it comes back, recovers, come back to the line. Why? Because people take profits. Then next blue line right here. Fed cuts again. What do? We go up, come back down, and go back up. Shaking off the buyers right here. Shake off the buyers, put it below the 50, make everybody think that we're going down this way. And all of a sudden, we go back up. Now, another rate cut. But TLT should be going down. But no, this rate cut came right here at this indecision candle. And what did we do? We went from $62 all the way up to 63 on the next day. The next day we pumped up. People take profits. We go back down. Then what happened again? Goes another rate cut. March 18th. March 18th, the Federal Reserve cuts another 75 basis points. What do? Markets pull back. Bonds go up. We're going to go forward in time now. We're going to have, now we change the dates. We have April. We're going to have April down there. April. And we're also going to have, all the way, stopping all the way to October, right? October, right there. Okay, we're back on the SPY. As you can see, we are back in the SPY here. What just happened there? Give me a second, fix that. Okay, we're back at the SPY, and now we're gonna go, and we said here in April 30th, the Federal Reserve keeps the federal rates funds unchanged, which means he pauses. Here comes the fun part. Let's look. April 30th. April 30th. Here comes a pause. There's the pause, guys. You want to pause? I'll show you what happens when a pause comes. The Federal Reserve pauses in April 30th. Then something else happens on June 25th. On June 25th, which we're going to mark right here. June 25th. And then something else happens in August 8th, sorry, August 5th. August 5th, the line is going to be right there. August 5th. And so let's go over what happened here. Here we are at that line, and we are there to April 30th. The Federal Reserve keeps the federal fund rates unchanged at 2.25%. This decision indicated a pause in the rate cuts as policymakers evaluated the effectiveness of the previous reductions. What were they telling us here? What were they telling us here? They were telling us that the Fed rates, that the hikes that they had made, that they believed that it was sufficient for the economy to start heading the right direction, and it was time to pause, and we can pause without a problem. And so the SPY didn't really believe in it too much. He kind of stayed sideways, kind of went up, and then what does it do? It hits the 50 moving average right here. I'm sorry, the 200 moving average. Hits the 200 moving average, gets a doji there, gets a doji right here, gets a doji, oops, gets a doji right in here, indecision candle, and gets right below the 200 right there, and it goes back down. It crosses the 50, and once it crosses the 50, at this time, it starts pulling on back. Now, this date right here. We are in June 25th. The Federal Reserve hikes the federal fund rate by 25 basis points to 2.5%. This marked the first interest rate increase since the series of cuts that began in September 2007. So this move was seen as a signal as the Fed was shifting in its focus towards inflationary concerns. What happened? Inflation came back. Oh my goodness. Inflation came back. That sucks because they thought that inflation was now under control. And basically the Fed was wrong. Just like Powell told us that inflation was going to be transitory, and it's been way too damn long. But the markets don't want to believe it. They don't want to follow it. And now let's go over to see what happened on those exact dates, but on TLT. And here we are now back in TLT. This is TLT right here, and we're gonna look at this first. Arrow, we already talked about it. It's just April 30th, and so it kind of got a consolidating area right here. Not too much to get excited about. But it extended. It took a month and extended to June, and then at this time right here is when we talked about June 25th that the Federal Reserve actually hiked again a quarter of percentage. Everybody thought at that time, I guess, it's just a quarter. A quarter, it should be fine, right? Maybe it's just going to be a quarter, then we pause and things are going to get better. But the problem here is that the market actually started the actual, not the market, but the actual TLT started going up. TLT started going up, and in here, as we come to August 5th, again, the Federal Reserve keeps rates unchanged. This decision signaled a pause in the rate hikes, as the Fed was confused. He didn't know. He's like, should I be hiking? Should I be pausing? What's going on? First I paused, then I hiked, then I paused again. And when he pauses, at this time, TLT rips. Why? Right? Because if you're pausing rates, that means that things should get better, right? Because you're thinking that, well, you've been hiking and the market was going down. So if you pause, then bonds should get destroyed, and then let's go QQQ, let's go tech, let's go everything up. We should be going up, but it's not the case. It's simply not the case. Now we are back at the SPY right here. SPY. And we're going to go back in time even further. And I took you all the way down to May of May 19 May of 2000. May of 2000. And the reason why I took you back here is because in in June of 1999, the first hike began. But in May of 2000, it was the last hike. The last hike came in May, right here. The last um, the last one was there. In fact, the pause came in exactly May 16th, 2000, which is actually, I believe, I marked it right there. May 16th. It will be this right there. Nope. Here. May 16, 2000. At that candle of indecision, I'm going to mark it right before. At this candle of indecision, the Fed actually paused. And so what happens? Let's take a look. May 16th, you got a doji candle of indecision there. Exactly at that bar. I'm going to move it off so you can see it. Or not. Um, right there. Moved it off. And we're going to have that candle of indecision. May 16, the Federal Reserve decided to pause. They wanted to keep the federal fund rates unchanged at 6.5%. This pause came after a series of interest rate hikes. And so you're looking for a pause, right? Let's see what happened when the market actually paused in the year 2000. So what did we do? We paused here. We went down initially. Wave up again. Consolidation right here. Wave up again. You had an area here that you can see that there was a resistance. If you draw a line right there like that, you would have realized there's a resistance there, although it had a peak, and then you could have adjusted it there, so it'll look just like that. And you came in here, you got rejected once at this line. You would again rejected at this line right here, rejected again here, rejected again here, and rejected again here. So if you're expecting that the second that the Fed pauses, the market is going to go up, I have bad news for you. Because when it actually pauses, the market does this. Okay? That is what I'm seeing. That is what it is that makes sense. Whether or not it will happen this time, we will find out. But I can tell you, and you can go and look at the other things, but in October 1950, we had the first rate hike. The last hike at that time was in May in 1953. What happened? We had a recession. October 1955 was the first rate hike. We had the last hike in August 1957. What did we get? Recession. September 1958, first hike. Last hike, September 1959. It lasted a year. What did we get? A recession. In December of 1965, we had the first rate hike. September 1966 was the last one. We had a soft landing there. And so on and so forth. I'm going to tell you, in the 67, 69, we had a recession. In the April 72 and 73, we had a recession. 77 and 80, recession. 1980, recession. 1983 and 1984, soft landing. 1987, 1989, recession. Now I want to remind you, the soft landing ones, if you go look at the yield curves during those soft landings, they were not what we have right now. We have the most inverted yield curve since 1981. So good luck if you think we're going to get a soft landing on this one. It's going to be hard. It's going to be hard. I'm not discarding it completely. I'm just saying, the odds of having a soft landing in this occasion is going to be extremely, extremely unlikely. June 1999, we had the first rate hike, and May 2000, it was the last hike, and I just showed you what happens in the markets. We had a recession. June 2004 and 2006, recession as well, and December 15 and December. We started in December 2015, last rate hike in December 2018, and we also had a recession. So when we look at the overall picture, now we're going to extend it. We're going to zoom out and we're going to see the whole picture. So here we are here. We're going to make some marks in here. Let's take a look. Now, we saw here, we talked about this date. And so I don't have to repeat myself. We're just going to go over. Same again, you can see the date down here. We're looking at the year 2000. And the year 2000, at the vertical line, you're going to have, so at this vertical line, you're going to have the pause followed by the rate cuts, which generated this pullback. Then you have a pause here, another, and hold on a second. I had an extra line in there in 2004. It shouldn't be there, but I fixed it now. So as you can see, it's zoomed out, guys. So it is sometimes difficult to be able to see the whole picture. But once you see what happens, the vertical lines are going to be when you had the pause and then followed by rate cuts. We had a drop here. Here you have a drop, although you don't see it very much because it's zoomed in. You had a drop there as well, and then followed by a bigger drop at a later time in 2007, 2008, and dragged all the way to the beginning of 2009. And then you had also in 2018, December 2018, which would be somewhere December 2018, which would be right here at that peak right there. So you also see that we had also a drop right there formulated after the pause and after rate hikes. And now finally I want to go over 2020 because I know exactly what people are going to tell me. Well, how come in 2020, when the Fed cut rates, we just kept going up and up and up and up? Let's go over it. Let's see if this is actually true. We're back at the SPY here. Back at the SPY, and now we are in March 2020. And I marked for you here this vertical line on March 3rd. And what happened in March 3rd? The Federal Reserve cuts the federal fund rates by 50 basis points to a target range of 1% to 2.25%, right? This was an emergency cut, which was the first unscheduled cut since the financial crisis in 2008. So what happened during that cut? Markets going up, right? Wrong. Markets went down. But why? If the Fed is cutting and he was raising rates, that means that now he stops and he's cutting rates. So that means that we should be going up. No, we don't. We don't go up. In fact, what does go up? Keep in mind this date. March, right? March 3rd. Let's go look around. Here we are at March 3rd. Let's find it. March 3rd. Buy gold, right? Buy gold. Is that right? Is it though? Let's take a look. This is actually gold. I put gold here for a reason. Okay. Here comes the cut. Gold did move up for 1 day, 2, 3, 4 days. How much did it move up from? 153 up to what? 159. And then what happened? It melted, right? It melted. Oh man, so I should stay in cash because I guess there's nothing good, right? Well, hold on a second. How about we look at March 3rd, right there marked for you. How about we look at TLT, bonds, iShares, 20-year plus, ETF. What happens to that? Let's see. This is March 3rd right there. What happens? The Fed cut 50 basis points. Whoop, up from 145 all the way up to almost 170. In how many days? 2 days. 2 days. You had a gap. You have a gap here, a gap there, and one more gap, and it shoots all the way up to 170. And what happens? People take profits. What do you do at that time? What is it that I'm going to do at that time? I'm going to sell my TLT. I'm going to get my money, and I'm going to throw it into the stocks that are worth buying on that drop. Because I just showed you the markets actually pull back when the Fed cuts rates. So for all you bulls, all these new bulls out there that are saying that you want the Fed to cut, you want the Fed to cut, but you are on calls, you're dead wrong. You're dead wrong. You want the Fed to cut, but you are on calls on the SPY or in the Qs, or you're buying stocks. So that means that you are not really short what you're doing. And if you go back in history, this is what history tells us. History tells us that we don't learn anything from history. And that's, my friends, I think that's going to be it for me. I think I spent a lot of time here trying to explain, trying to engrave into your brains that when the markets pause and when the markets cut, when the Fed pauses and when they cut, the markets actually go down, not up. So that's it for me. Good luck on everything. I think that time is coming. I think that the Fed is going to probably pause this time around. If he doesn't pause this time around, he's going to break something else. And the banks are already beginning to break. They are not telling the truth. They are not telling us the truth about the banks. And there's going to be more banks going under. And we might get a repeat of 2007 and 2008 if the Fed pauses too early. And I believe that he's afraid of causing that break one more time. So he continued to continue to raise rates. He's going to see if the CPI, which is a lagging indicator, which is in fact is stupid to be looking at as a guide, but that's what he's looking at. If you look back in history, and for example, I'll give you an example. In 2006, 2007, the Fed paused in July 2006. The first Fed cut was in September 2007, and the beginning of a recession was in December of 2007. Okay. At that time, it took 4 months to hit a new low in the S&P 500. It took 4 months to get to a new low. Then in the 2000s, the Fed paused in the 2000. Then he cut in 2001, and the start of a recession was 3 months later in 2001 by March, and the S&P 500 showed us a new low by October. 7 months it took to come down, guys. 7 months when nobody thought, everybody, nah, we're not gonna go down anymore. How about 89 and 90? In May 89, the Fed paused, and the first Fed cut came in September. It came in July 89, and the start of recession was in July of 1990. It took a whole year for the recession to begin after the first Fed cut. And guess when? Recession, the new low came. That one came really fast. It took about 2 to 3 months to give a new low on the S&P 500. In 81, same situation. In 81, the Fed cut in September of 81, and the recession began in July of 81, and we hit a new low in the S&P 500 by August of 82. It took us, again, one whole year for the market to show us a new low. So don't discard just because you're seeing all this bullish momentum. Don't discard another pullback because back in the day, everybody was discarding it. All right. And just to get an idea, 1980, 1982, from peak to the bottom, we dropped 27%. Okay. We lost 1,350 points. Okay. Now, 1987, 1988, we dropped 33%. 1990, 1991, 20%. 1998, 19%. 2000 and 2003, 49%. 2007, 2009, 57%. So let's just take away the worst case scenario, which is the 2000 and 2007, and take those away. Those were 49% and 57%. In 2018, we dropped 20%. In 2020, we dropped 34%. So you're looking at an average of between 20 and 30% from the peak. The moment that the Fed cuts, is likely to pull back 20 to 30%. All right, guys. That's about it for me. I think I hope you get something out of this video. At least do your own research, see if anything makes any sense. Start looking into what you should be having your money in, and good luck in the markets, guys. Have a good one.